Divya ma'am, I have also heard about transactions in business. Do you have any idea about this subject?
Sure, there is also a factor called recording business transactions. Without business transactions records, it will be very difficult whether the business is in profit or loss.
Can you tell me more about how the transactions are done in business?
Sure, for that, you will have to first know about the 3 financial statements used to record business transaction.
What are they?
The 3 financial statements are used to record and report a business transactions are balance sheet, profit and loss statement, P&L, and statement of cash flows. Let's first learn what a balance sheet is. A balance sheet is a record of all of a business's existing assets, liabilities, and equity. It measures the uses of capital. Capital must equal sources of capital. From that, we can derive that total assets is equal to total liabilities plus equity. A balance sheet changes all during the year as a business repays capital, raises new capital, acquires new assets, and sells old assets. However, at all times, total assets must equal total liabilities plus equity. Equity and liabilities come first in a balance sheet, followed by assets.
Divya ma'am, can you provide me with a simple example so that I can understand better about balance sheets?
Sure, Anil. To understand the concept better, let's look at a simple example. Let's say that a person Raju has 20,000 rupees and wants to buy a thela to sell vegetables. The 20,000 rupees is his equity in the business. He has provided 20,000 rupees of his own money for his business, which will be recorded on the asset side of the balance sheet. The balance sheet will show that the equity of Raju is 20,000 rupees, as he has the asset of 20,000 rupees. His liabilities is 0. Now, let's say that he pays 10,000 rupees in cash to buy his thela. The balance sheet will now show that his equity is 20,000 rupees, while his cash asset is 10,000 rupees, as he paid that amount to buy the thela. His liabilities still remain 0. The purchase of the thela is now recorded on balance sheet. From the table, you can note that the left-hand side of the balance sheet has not changed because Raju has not provided any additional capital to his thela business. A balance sheet is incomplete without a P&L statement.
What is a P&L statement, ma'am?
Well, let's look at what P&L statement is. P&L statement is a record of all of a business's revenues and costs over a certain period of time. Most often, it is calculated every quarter or every year. A business's profit is defined as the difference between its revenues and all its costs. Continuing with the same Raju Thelawala example, let's say that Raju spends rupees 2,000 to buy vegetables. This is his cost. For now, let's not worry how this will impact his balance sheet. He then decides to sell his vegetables for a total of rupees 3,000. This is his revenue or sales. His P&L statement is now can be shown as rupees 3,000 as the total revenue, while the cost of purchasing the vegetables is rupees 2,000. His profit is revenue minus cost, which is rupees 1,000. Actually, the P&L statement records all transactions on an accrual versus cash basis.
Accrual versus basis?
Let me explain what accrual versus cash basis is. In the case of Raju, the Thelawala vegetable vendor, let's say that his customers will pay him the rupees 3,000 only at the end of the week. On an accrual basis, the rupees 3,000 will be recorded as revenue on the day he sells the vegetables to the customers, regardless of if and when the customer pays him. Similarly, if he has not paid the rupees 2,000 to the person who supplied him the vegetables today, he will still have to record it as a cost on the P&L statement today itself, even though he may take 7 to 8 days to pay his vegetable suppliers. This is accrual versus cash basis business. So without the calculation in accrual versus cash basis, if transactions were recorded on cash basis on the P&L statement, in this situation, he will have 0 revenues, 0 costs and 0 profits because his customers have not paid him and he has not paid his supplier. To better understand such a situation, we need to know the statement of cash flows.
So, we also have to keep a tab on the factor of cash flows, ma'am?
Exactly. Without the statement of cash flows, it will be difficult to know how the business is functioning monetary-wise. Given that the P&L statement records transactions on an accrual basis, it is difficult to use it to understand how much cash a business has on hand at any point of time, especially for the large businesses having many transactions. The P&L statement also excludes any asset purchases or sales, as well as any capital raised or repaid. A business cannot survive for long without cash. The statement of cash flows fills this gap. Cash flows keep track of cash-related revenues, costs, investments, and financing, and report the additional cash generated or used by a business every period.
So, ultimately we can see that cash is king.
Definitely. Let's learn more about statement of cash flows.
Does cash flows also consist of many parts, Divya ma'am?
Yes, it does. Cash flows consist of 3 parts. Cash flows from operating activities, cash flows from financial activities, and cash flows from investing activities. Let's look at each of them to check how they work. The first is cash flows from operating activities. Operating activities include all activities related to the purchase and processing of raw materials and selling of a business's products and services. The second is cash flows from financing activities. Financing activities include capital raised through debt and equity, as well as loans repaid and dividend paid. The third is cash flows from investing activities. Investing activities include purchase and sale of long-term assets like plant, machinery, computers, furniture, as well as shares of other businesses.
Would not it be very difficult to know how the cash is flowing in a bigger business situation, ma'am?
Definitely. For that, there is a system called recording of transaction. Let's try to understand how this concept works. A large business may have hundreds, thousands, or even lakhs of transactions each day. So, it is difficult for it to keep track of the large number of transactions and constantly updating the balance sheet, P&L statement, and statement of cash flows after each transaction. Missing out even a single transaction could have serious consequences for the business. Accountants worldwide use the double entry system to record transactions.
Double entry system? What is it, ma'am?
Transactions are entered into the general journal in the chronological order, including which accounts each transaction affects. Every transaction in the general journal has two entries, a debit and a credit. For this reason, it is called double entry system, which impact at least two ledger accounts. Debits are entered on the left-hand side and credits on the right-hand side. The total on the debit side must equal the total on the credit side for every transaction.
Does that mean that the general journal looks very complicated, ma'am?
Well, no. If you look at the general journal in a simple way, it is not very complicated. This is how the general journal looks. The first entry is the date. It is the date of the transaction. Then we need to enter the particulars. Each transaction affects at least two accounts. The names of the accounts are entered here as well as a brief explanation of the transaction. Include a DR at the end of the line of the account being debited. And start the line of the account being credited with a TO. Then enter the ledger folio. Entries from the journal are posted to ledger accounts. This column records the page number of the ledger account into which the entry is made. It is either debit or credit. The debit is the amount being debited from at least one ledger account. The credit is the amount being credited to at least one ledger account. A ledger account lists all increases and decreases of a particular account. Examples of ledger accounts are cash account, debt account, inventory account. Ledger accounts can broadly be classified into personal accounts, real accounts, cash accounts, and nominal accounts. Personal accounts are accounts that relates to persons like capital account, salary account, bank account. Real accounts are accounts that consist of properties of the business like cash account, stock account, patents account. Nominal accounts are accounts that consist of expenses, losses, incomes, and profits. The general ledger is a collection of all ledger accounts. Now, the rule of the thumb is how to determine if something is a debit or credit.
Well, how is it done, ma'am?
The rule of thumb relies upon the personal accounts, real accounts, and nominal accounts to check the debit or credit. In the personal accounts, the debit is the receiver and the credit is the giver. In the real accounts, the debit is what comes in and credit is what goes out. In the nominal accounts, debit is all losses and expenses and credit is all profits and incomes. Now again, if you look at the example of Raju, the thelawala, and how he started his business, you will understand better. Raju increased equity capital from rupees 0 to rupees 2000 and at the same time increased cash from rupees 0 to rupees 2000. Cash is a real account because it is owned by the business and it is coming into the business. Also keep in mind that debit is what comes in. Raju's contribution is capital he gives to his business and hence is a personal account that needs to be credited. Again, remember, credit is the giver. So, this transaction will be entered in the general journal, assuming that it is done on 1st January 2019. On 3rd January 2019, he spent rupees 2000 to buy vegetables and sold them for rupees 3000. Cash is still a real account. The purchase of vegetables will be credited for rupees 2000. The credit is what goes out. At the same time, the sale will be debited for rupees 3000. Purchase and sales accounts are nominal accounts. Here, the credit is all profits and incomes and debit is all losses and expenses. These transactions will be entered in the general ledger as shown on the screen. It first starts with the date, then particulars, then debit, and at last the credit, as we have already discussed. His cash account in the general ledger will look as shown on the screen. Here, the particulars and the amounts are highlighted. You can also notice that it starts with a DR and the end with a CR. This is about debit and credit. Raju's capital account in the general ledger will look as shown on the screen. The Thela account will look as shown on the screen. The purchase account will be as shown on the screen. As he had purchased vegetables for rupees 2000, it is entered to the cash account row. Raju's sales account will be as shown on the screen. As he had sold the vegetables for rupees 3000, it is entered under the particulars column along with the amount. Now, can you understand how the entries are made into the ledger, Anil?
Now I understand how business transactions are recorded. Thank you, Divya ma'am.
You are most welcome, Anil.